Good morning, good afternoon, good evening, everybody. It's great to see you all here. Let's give another 30 seconds for participants to join in. We would love to see where you are joining us from today. Please type in your locations in the comments. Okay, welcome everyone in today's LinkedIn live session. Over the past few months, we've been receiving a lot of queries, requests from organizations and our members, both enterprise buyers as well as service providers in the Asia Pacific region around this topic. And we wanted to bring some insights in a more informal and interactive format. So thank you everyone for joining us today. In today's session, we will talk about what is top of mind for enterprises in this changing economic environment, and how pricing is expected to evolve through 2023, and what are some of the action items that one could do to ensure cost control in what is increasingly a buyer's market. We would love to hear your comments as well as your questions. So please do type in as they come in as we go along, and we would try to address them during the discussion or towards the end during the Q&A. As a quick introduction, I'm Ashish Sahadev, Vice President with Everest Group, and I lead our business in the region. And I'm joined with two of my esteemed colleagues, Abhishek Sharma and Rahul Gehani, both bringing in a wealth of experience and expertise in this area. I'll let Abhishek and Rahul quickly introduce themselves.
Sure. Thanks, Ashish. Hi, everyone. Look forward to the interaction today. My name is Abhishek Sharma. I'm a partner with the firm and co-lead our pricing assurance practice along with Rahul. Look forward to the discussion today. Rahul?
Yes. Hi, everyone. Good morning, good afternoon, good evening. My name is Rahul Gehani. I'm a partner with Everest Group, co-head the pricing assurance service line along with Abhishek. Been with the firm for about 8 years and looking forward to a great discussion.
Yeah, thanks, Abhishek and Rahul. So let's start with some context on what transpired in 2022. It started with a strong market for outsourcing, and then within the last 12 months, we're starting to see some kind of uncertainty due to geopolitical and economic concerns. And there is reprioritization and delays in spend with the focus on cost management and value. So we live in interesting times. Rahul, Abhishek, and I have been in the industry for over 2 decades now, and we've never seen the market evolving and changing so fast. So Rahul, what is your take on things which got us here?
Yes, Ashish. So, if we kind of take a quick step back and see, how things transpired over the last 12 to 15 months, starting, let's say, from the beginning of 2022. Uh, in January, when we started the year of 2022, we were in an environment in which demand was surging, for most service providers. Buyers or enterprises were not able to get their demand for talent, demand for services met by, let's say, just having handful of providers, and hence they got into the mode of portfolio diversification. And that was a time when we saw pricing really increasing across the board. As Q1 transpired, there were some early talks of stagflation, recession coming up. This was also the period when geopolitical risks were really peaking, and subsequently, Russia invaded Ukraine, as we know. And by the time we got into Q2, there was a surge in inflation globally, and especially Europe. We saw was really impacted by the energy crisis. Uh, Central banks all over the world had started increasing interest rates. There was increased talk of recession, and we could see slowdown in some pockets, or slowdown in buyer decision in some pockets. By the time we hit Q3 and Q4, we generally saw that while demand continued to be stable, but there were signs of, let's say, something on the lines of modernization fatigue. Many clients saying that we have done so much of digital transformation in the last 1 year, 2 years. It's time to now take stock of where we actually are, try to get more value out of all our investments, get into a cost management mode. And today, as we speak, a lot of these elements are still valid. So, Abhishek, I think some of the trends that we are seeing now, they have also been impacted by this unreal surge that we saw for a big portion of 2022. Your thoughts on that?
Absolutely. Thanks, Rahul. So, I think we're in a very interesting space right now. Now, thanks to the talent shortages and wage hikes, attrition, etc., the cost base has definitely ballooned right across the industry for service providers, of course, even enterprises. For their internal talent, because attrition hits everyone, talent shortages hit everyone. There's also been some potential overhiring because I compare this to a fight or flight syndrome, that when we're not finding talent, there's a tendency to just go across the board, overboard, and try and figure out, wherever we can, let's just get them in, so that if the crunch increases more, we're not left, high and dry. Now, what's happened is that, effectively, because of that cost-based potential overhiring, the moment there's a bit of a wobbly nature in the economy, things can turn topsy-turvy pretty quickly, right? So I think, the uncertain situation we're in, we're seeing some rebalancing of portfolios happening. It all leads to a more precarious situation because of the already inflated cost base. So I think that's one element, right? And becomes more problematic when cost control sets in, as compared to, let's say, a usual recession where it's just shedding of a few pounds. Now, the other element which complicates matters is also that certain skills we believe will still be in short supply, whereas others might see a greater degree of softening, etc. I think the critical part for service providers and enterprises is to figure out which of the skill to really keep a premium on, keep a tight view on supply, whereas others which could be more amenable to that. So a one size fits all, broad instrument approach might not work in the coming year.
Yeah. No, thanks, Rahul, Abhishek. In fact, to get a view of what is on top of mind of the stakeholders, Everest Group conducts a key issue survey annually. And the results have been fairly interesting in the current version. And we've seen the trends over the last few years and how it evolves. Before we show you the results, I'd love to see what participants think about it. And so we would love to ask, what is the number one top of mind sourcing issue in 2023? So participants, please type in, what do you think is your number one top of mind sourcing issue for 2023? Is it talent, flexibility, or cost control, or anything else that may be on top of your mind? Yeah. Thanks, Sanjay. Yeah, we have some responses pouring in, but let me talk about what we are seeing and very briefly. So if you look at the price and cost pressures over the last 3 years, we've seen clearly that this year it is on top of mind, and it has consistently jumped up places from 3 in 2021 to 2, and then now being the number one issue. So Abhishek, the The price and cost part was somewhat expected. What other aspects are interesting to you in the 2023 key issues survey?
Absolutely, Rahul, and I think it's time now to bring up the slide, which shows the results of that. So one of the things which kind of struck me was the fact that evolving customer needs, right? If you go to the next page, which shows it. Uh, yeah. So kind of adapting to evolving customer needs seem to have got pretty much center stage again. It's at rank 2, and it had moved to rank 3 in the past year. So for me, I think there's going to be a couple of nuances of this, and this is important to note. One is obviously around flexibility, right? Flexibility around services, being more amenable, being kind of understanding of what's required. If it means changing skills, if it means changing talent pools, that's the whole evolving customer needs aspect around how they mold themselves to deliver the service. Right? The second element also in my mind is going to be definitely around commercial flexibility. Right? Whenever talent is in short supply, we see a lot of focus, and I've seen enterprise procurement, just saying, hey, we are not pushing for SLAs, we're not pushing for cost reductions or cost control. Give me the talent right now, please, right? Because imagine, millions of dollars of projects stuck and the business stakeholders literally breathing down the neck. That is not the time to look at, hey, where's that metric? Everything just goes, get me the talent, we'll figure something out. Okay. Now people are realizing that, well, that's not typically how a partnership based outsourcing construct works, right? There was a lot of churn, a lot of change during COVID, but I think that's where this is going to come center stage, and we would see a renewed focus on types of commercial models, types of pricing models. What's the win-win, what's the kind of element in which there's better commercial outcomes also, rather than just getting the talent across. So I think that's something to watch out for, interestingly, especially in the Asia Pacific region, more so than perhaps some of the other geographies. The other element which really struck me was, if we look at the jumps which across the parameters or across the kind of areas which we've seen, the most outstanding is the slowdown in demand from rank 10 to rank 4. This is a bit worrying. If you look at it, all the others, 1 or 2 ranks, 3 ranks here and there. This is 6 ranks of a jump. So this is definitely something for concern. The 2 years of post the initial COVID hurry and uncertainty, people had already forgotten what slowdown in demand looks like, right? What does it mean fighting for that last dollar? It was all about, hey, this is there, how do we deliver? I think that's going to be changing in focus, which has severe implications for pricing, commercial behavior, how both sides of the table behave. So yeah, I mean, are we looking at an early 2020 type scenario? Are we looking at like a 2008 scenario? That remains to be seen, because these are the two key takeaways which may not be as evident as we look through the table per se. Yeah. So one of the things which we also thought was which I also covered a few seconds ago, was that the talent and skills shortage still remains among the top three. Was a confusing factor. Rahul, what's your sense on how that could potentially play out, right? The skills and talent part in the coming months.
Yes. So Abhishek, talent shortage we expect will continue to remain as one of the top challenges in the minds of both buyers and providers. So thankfully, it is not the top ranked challenge anymore. Uh, and as some of our audience would have seen from our publications and reports, as well as webinars in recent months, we regularly track dimensions such as attrition, extent of unmet talent demand in various geographies across the world, across various services or skill sets. So the good news is that over the last 6 months, there has been a respite in attrition, as well as the extent of unmet talent demand that has come down a little bit in most locations across the world. Even specific to APAC, be it Singapore, Australia, India, Philippines, there has been some improvement on either one of these parameters or both of these parameters, um, especially for traditional skills or generic skills. However, for what we call the next gen skills or the digital skills, we actually do not see a very big relief coming in, and this will also be reflected in the pricing forecasts that we have for these skills. We'll touch upon this, in more detail in a few minutes. But one final point for the time being is that this continuing shortage, as far as the next generation skills is concerned, is despite the large number of layoffs that are happening in the tech space. So it just makes one wonder, if that had not happened, what kind of surge we would have seen, what kind of a gap there would have been between demand and supply for the next gen skills.
Yeah, Rahul. No, totally agree, and I think this whole thing also varies by skill type, right? So there's a whole skill spectrum, which kind of varies in terms of the talent supply and demand gap, as well as its impact on pricing. So Rahul, what do you see there? How does this vary based on skill types?
Yes. So first of all, maybe a quick note on how we believe it makes sense to segregate different types of skills. And
Hmm.
generally, we believe that looking at it in a very simple way, by classifying them into traditional skills or specialized skills, generally resonates well with most enterprises and most service providers. Now, traditional skills are the mature technologies like Java, .NET, ABAP, Perl, server management, storage management. These have been around for a very long time. They have a very stable demand, but a large labor pool exists, with these kind of skills. But when we talk about specialized or next gen digital skills, we are referring to cybersecurity, cloud, analytics, AI, ML, data science, automation, UI, UX. These are the kind of skills which are essentially newer, and they are in a lot of demand today. Very few people are currently having these kind of skills. While there is a massive amount of training happening, the reality is that there continues to be a big gap between the demand and the supply for these. So these are the ones that generally command the pricing premiums as well.
Yeah, and if I may add, one of the things, just to add to what Rahul mentioned, see, it's important as enterprises, look at that. Also, how certain skills which may have been premium or specialized in the past, right? They could be considered relatively traditional or standard today, right? So I think this is a nuance to bring in, because enterprises we've seen continue to pay high premiums due to what I call the premium inertia, which is set in. Hey, that was signed, it got renewed, maybe back in 2019, and at that point, this particular skill was considered super premium or something. Now that might have kind of gone down. So while it's important to keep the segregation on, it's also important to make sure that the segregation into premium, standard, niche, etc., is reviewed at regular points in time to make sure that people are not stuck on the old definitions. That just keeps it much more current along with the market. I think, Rahul, in along those lines, as we segregate the skills, I think the past 12-month rate increase analysis, we did, should make for an interesting conversation, as we can talk through some of the divergences, and we can also see how that plays out in one skill type versus the others. So I think if you bring up that screen now, we can have a bit of a conversation on that.
Yep. So we have it on the screen now. So if you look at it over the last 12 months, we do see a difference in the way the price increases actually happened for the traditional as well as the specialized skills. And we're showing, IT application skills over here as a representative example, though the same thing generally applies for IT infrastructure as well, as well as on the BPO side. But as we see currently for IT applications, if we focus first on the onshore geographies, For traditional application skills, again, which are .NET, Java, C, C++, etc., uh, we did see an increase of somewhere between 2 to 6% at onshore geographies. There was a little bit of a variation between different types of onshore geographies. For example, we saw the extent of price increase to be the highest in Australia, where it was about 3 to 6%, and it was lowest for the Middle East, roughly about 2 to 4%, and Singapore and Japan was in between these two ranges. And then if you look at the specialized skills, which is basically your full stack developers, experience design, IoT, 5G, so on and so forth. Again, the broad range was about 3 to 7%, though there were some nuances. Again, Australia was a bit towards the upper end of this range. Middle East was a bit towards the lower end. Singapore and Japan, in the middle. Abhishek, with regard to the offshore, you want to comment?
Sure. Thanks, Rahul. So if you look at offshore, there's an interesting story. One, within offshore, the ranges which you've seen seem to be higher than if you look at even for the traditional skills, it's anywhere between 2 to 8%. And if you look at kind of the specialized, that extends from like 2 to 9%. It's quite a range. Not surprisingly, India, being a primary kind of a delivery location for a lot of tech-based services, the hike has been higher. Inflation has been high. Attrition has been pretty much at an all-time high, and that's really led to either kind of companies paying higher to attract talent or paying higher to retain talent. In either ways, there are cost implications across the industry. So across the industry players, now that has led to anywhere between 4 to 8% for or kind of the traditional skills and slightly higher for the specialized skills because of the talent supply. Philippines, if you look at it, it's been mostly controlled. It's not been as high, primarily due to the fact that perhaps yes, IT work does happen in Philippines, but not really at the scale or the number of people required or the huge campuses which need to be filled up as compared to let's say India. So that's been mostly in the 2 to 4 5ish percent range as well. China, as you see, it's interesting. The ranges have been less governed by whether it's traditional or specialized. It's kind of within that range only what we've observed. But yes, it's we can see that it's kind of closer to the kind of ranges which we've seen for India geography increase as well. So yeah, that's kind of something again to figure out. Offshore has seen a relatively higher pricing pressure or pricing kind of movement as compared to some of the onshore APAC geographies that we've shared.
Yeah. I mean, just to be clear, Rahul, these are rates, not the wage inflation, right? That, of course, would have been higher.
Over here is the increase in the rates or pricing, and we're not talking about wage inflation over here.
Right.
And you are correct, wage inflation is generally higher than the increase in the pricing. For instance, if you talk about Australia and Singapore, the wage inflation over there has been roughly about 5 to 8% over the last 12 months for traditional skills. In an offshore location like India, we witnessed wage inflation of roughly about 10 to 12%. Now, of course, wages only account for a part of the operating costs. There are other elements like real estate, facilities, telecom, equipment, SG&A, so on and so forth. And many of them either remain stable or they did not really increase the same way as wages did. Net, if you kind of look at India, for example, a 12% wage inflation in India actually led to about somewhere between 6 to 8% increase in the operating costs. So as a result, the market kind of gravitated towards the price increases that we are showing over here because these roughly tie in with the operating cost increases as well.
Yeah. So Abhishek, having discussed this, what does then the future look like? Are we looking at an early 2020 kind of a scenario where COVID-led uncertainty caused rate drops, or do we expect things to be relatively controlled?
Yeah, Ashish, I'm reminded of the phrase which you mentioned at the start of the discussion that, all of us have individually been more than 2 decades in the industry. There's a lot of firsts which are happening this year. So normally what happens is that in the first quarter, Rahul, myself, and a few of our colleagues, we just take a look that, hey, what is pricing? What is our projection as to how it'll move? Looking at recent trends, movement, behaviors, etc. This time, what we've had to do is basically create two scenarios because, simply, depending on which economist, we read or which bank report we read, it's still out whether it's going to be a proper recession or it's going to be what we call currently happening as continued uncertainty, right? Yes, there's a lot of talk of recession, but try and book a flight, try and get a hotel room. I mean, the cost will surprise us. Book even a simple phone or a laptop. I'm not even getting into the prices of cars here.
Yeah.
So yeah, I mean, it's like a recession versus, there's practically zero discounts on anything, right? So there seems to be an odd case. But having said that, things are moving fast. So what we've done is we've basically played out two scenarios and then, seeing how pricing could move there. So the first scenario, which I'll talk about, is potentially what we would call a proper recession, right? So that's what's sharp decrease in consumer demand, sharp increase in unemployment, major acceleration in frequency and magnitude of layoffs, very strict hiring freezes, majority of projects cancelled or slowed, and typically early COVID type buying or negotiating behavior. So that's what we're calling kind of scenario A, right? And we'll talk about that in a few minutes. Rahul, do you want to describe how we built up scenario B?
Yes, scenario B is essentially uh, a situation where things kind of continue in the same way that they currently are, which is essentially the cautious mode that buyers are having today. That would continue. It would be continued uncertainty. In some pockets there will be reduced demand. Though overall the fundamental demand would kind of sustain itself. Some companies might resize or rescope their talent pools. There could be some reduction in employee attrition. Discretionary spend on the part of enterprises getting more scrutinized, but not completely getting stalled. That's where we broadly currently are, and that's scenario B. Where this kind of a situation would continue.
Yeah. So what do the participants think? Would love to hear from them on the chat. Do you see similar price increase or movement? Let's say for India deliveries for standard IT services, what do you guys see? Less than 3%, 3 to 5%, more than 5%, or do you see similar to what Rahul just described? Yeah, more or less similar, seems like. Oh, thanks everyone. Rahul, it is interesting that we don't expect a reduction in pricing, even in the case of a proper recession.
Yes. So we are not saying that even if there is a proper recession, there will be a complete uh, disruption of the demand. The way we are expecting things to actually play out is even in this kind of a situation for a lot of skills, which are essentially which we could classify as, let's say, keep the lights on. There's been so much of work which has already happened over the last 2 to 4 years. I mean, companies cannot just turn off that particular part of the IT estate or of the business process operations. They still need to kind of sustain themselves. So demand for newer work could get impacted, but a lot of demand for just keeping the lights on what has already been done or what is currently in flight, that will still remain. So hence, the shortage that we are seeing, it will not altogether go away, though it will definitely diminish than what it currently is.
Yeah. And one thing, Ashish, which I also want to highlight is that this scenario is is basically, what we would call in the classical sense a recession, and not, God forbid, mayhem, as we call it, right? Mayhem scenario, for example, would have much more intense ramifications, though at this point it seems relatively unlikely to happen. Mayhem would mean, really, really everything, organizations coming crashing down. Yes, we have seen a bit of some bad news on the financial institution side over the past 1 week, but yeah, I think true mayhem would be, again, like I said, God forbid, if larger institutions would be greatly impacted. So yeah, that needs to be seen, in that context also, because there's variations of recessions which may come in.
Yeah. So Abhishek, which one of the two scenarios we talked about do you think is likely to happen?
Yes, Ashish. So, in a lighter vein, the answer depends on which economist or investment analyst report we read, right? Like I said, it's all over the place, and a few of our colleagues sometimes, we joke that are we talking ourselves into a recession, because there's just so much of talk happening, right? But having said, I think let's look at the projected numbers for scenario B and talk through some of this. So, as we bring up the next screen, right? This is effectively going to be where we talk about, on the next page, right? Where we talk about, you know effectively the continued uncertainty, right? Now, if we look at it, this is where, yes, there will be, as I described, probably describe the scenario B, how it looks like. Now, the standard IT skills, yes, there will be somewhat of a muted nature as compared to what we saw last year. Standard IT skills could be anywhere between kind of 2.5 to 5%, depending on onshore versus offshore, and you see those converging pretty close to one another, right? Specialized IT skills, definitely the upper end would be higher. They could remain as high as 6 to 7%, right, on the top end of an increase, and that's primarily just adding to what Rahul mentioned. There's still major projects which are in play, for good or for worse, that they will require a lot of hard to find skills, be it cybersecurity, full stack, cloud kind of, skills, etc. Just in term, as a reference, just a few hours ago, last night, we were speaking to one of our large financial services clients, and even today, they are really really facing issues with finding cloud migration talent, right? To the extent of actually
Wow.
changing their sourcing approach and model to do that. So clearly, where there's talk of, there's suddenly going to be a shortfall, the right kind of talent is still extremely hard to find in certain pockets. So if this continued uncertainty, i.e., expensive flight tickets and expensive hotels remains, let's also be prepared for expensive resources, right? That's as bluntly as I can put it, right? And to be clear, I think a few areas where we could see some kind of subdued nature coming in is things like customer service or finance and accounting. I think along with the great surge and everything, they had increased quite a lot. We do expect them, right, to be, again, relatively muted on the lower end, around the 1 to 3%, as things may come up. But yeah, coming back to your question, Ashish, which one is more likely? Given current visibility, right, even including the happenings of last week, we still believe scenario B is more likely to play out, as compared to scenario A. But I think the last couple of weeks, the next 2 weeks of March and early part of April, I think will give us a better view as we see if there is any domino effect of a couple of the banks which have seen troubled times in the past 1 week.
Yeah, yeah. But Abhishek, very interesting. Do you think, Rahul, do you think it could actually go to as high as 5 to 6%, even in this environment of uncertainty?
Yes, Ashish, there are a few reasons why we believe that. First of all, if the talent situation remains challenging, which is our expectation, in spite of the improvement that we have seen in recent months, uh, one can still expect wages to keep on increasing. That's one very important factor. And let's keep in mind, this is a scenario where, as we explained earlier, we still are forecasting that the demand will fundamentally sustain. This is not that mayhem kind of a situation, or a recession kind of a proper recession kind of a scenario. So there could be pockets of slowdown, but again, a lot of the demand will remain stable and it will keep on increasing. Plus, if you kind of look at another factor beyond wages, so Abhishek talked about costs of automobiles, flight tickets, hotels. Let's also look at real estate. Real estate costs in India are kind of going through the roof. My friends in Singapore say the same thing about that geo as well. I think that's generally the trend that we have seen in a lot of countries all over the world. So be it, let's say, providers opening newer centers, by setting up their own facilities, or even if they're taking them on rent, even the rental costs are really increasing these days. So overall, operating costs are very much on an upward curve currently. And due to which we believe there will still be pressure from providers to increase pricing so that they remain profitable, they maintain their current margins. Also keeping in mind that it's not as if in all the outsourcing relationships that exist, there have been levels, there have been price increases, realized by providers over the last 12 months. There were situations where, for practical reasons, pricing was still super competitive. There were examples where the deal was signed, let's say, just about 15 months, 18 months back, and there was no opportunity to increase the pricing till now. Now, as such kind of contracts come up for renewal or come up, near their anniversaries, that's where we'll see providers pushing for price hikes, which were not realized till now.
Yeah. Yeah, no, thanks, Rahul. This is very interesting. What's happening in the market, or what we are seeing. So far we've covered what we see in the market. We've talked about the cost pressures, as well as the talent shortages. We've talked about some of the insights around how pricing could vary by skills, as well as played out two scenarios: scenario A, where there is a proper recession, and B, where there is continued uncertainty. I'd like to just pause and see if we have any questions from the participants. If there are any questions or clarifications, comments on some of the numbers or inputs we've shared so far. Thanks, Kapil. Yeah. Sanjay, thanks. Seems like you're seeing the same things that we are seeing. Okay, so we also want to speak about what some of the actions our enterprise is taking, or can take to navigate through this situation. One of the themes that we have seen is the introduction of additional providers in the mix to increase competition and challenge the rather large rate increases being asked for by the service providers. So Abhishek, do you want to speak about that?
Sure, absolutely, and this is something which we've seen over over the past few months, happening. Now, it's interesting because more and more organizations are now looking at seeing or reinvigorating their vendor consolidation initiatives, right? Which went haywire because of the talent crunch, and now they're taking it back. But as a bit of a precursor to that, what many organizations or enterprises have seen is that wherever they've had a lot of inflexible behavior around either very aggressive price posturing or aggressive pushing for rate increases, and clearly they're at their wits' end. They're trying to include some additional providers into the mix, more as a bit of a trial to see if they can get better prices, and if they're getting prices, how does the work look like? How is the kind of team that's being put through? And that kind of factors into their whole vendor consolidation efforts, right? So rather than obviously getting stuck with the existing lot and then again high chances of giving the major part to an incumbent. They're trying to figure out, how what some of the other providers might look like. And we've seen a couple of examples. We've seen many examples, but just to share a couple. A leading financial services company, introduced another strategic transformation partner for systems integration projects, right? To include both better price competitiveness as well as solution sizing validation, because they believe that not only were they pushing for higher fees or higher rates, they were also giving them a good solution because there was no competition, right? It's like take it or leave it, right? And the same thing would apply also to rather transactional commonplace work like traditional testing or applications maintenance services, where bringing other providers into the mix, cutting out the portfolio and figuring out if there are others who might be more open to better pricing or commercial models, etc. So yeah, that's definitely something of a tool which is being used more as a precursor to negotiations or vendor consolidation, right? I think just adding on to that, Rahul, a few days back, we were also discussing some of the non-rate levers like FX, etc., and how they play a role. I think the time is also right for enterprises to take a relook at them.
Yes, I think a few important things that come to our mind. Firstly, there was a lot of discussion around COLA, cost of living adjustment, last year, and we saw, very strenuous negotiations happening, between the two sides as far as that is concerned. Now, our take on that is, instead of leaving it, for the two parties to thrash it out, in an open-ended negotiation each year. It's better to embed a proper COLA clause, which is equitable to both the sides. That is a good way of sustaining a balanced relationship between the providers and the enterprises. That's point number one. Point number two is, there seems to be a myth in the industry that, okay, we need to keep on increasing the stringency of SLAs. If my peer organization, there's a peer, who's having very high SLAs, even I should aim to achieve that. We don't believe that is the right way to look at it. Overly stringent performance metrics or SLAs, they add to the risk from a provider's standpoint, and ultimately that plays out in higher pricing. So it's very important to understand what kind of SLAs, let's say, are really necessary for your business, and only aiming to get those, as commitments from your providers. The third, which is very important as well, is moving away from pure FT based or input based models, and adopting some of the alternate pricing models. That's where a lot of action is starting to happen. I think that's really something to watch out for.
Yeah, Rahul, the pricing model part is very interesting. Good you brought that out. So do we see more of output or outcome-based pricing models being adopted, especially in areas where arbitrage quantum may be low?
Yes, Ashish, definitely. I mean, for certain services, I'll say, like for IT infrastructure services, even for transactional BPO services like accounts payable, accounts receivable, contact center, it's very common to now see that. Uh, in an area like procurement outsourcing, linking the fee realized by the provider to the savings which have been delivered to the client, as far as procurement is concerned. So that's another way of linking the fee to an outcome which has been achieved. But even in some of the other areas which historically have followed, let's say, an FT based approach, examples being application development, system integration, there are examples of newer set of providers who are trying to make their mark, who are trying to differentiate themselves uh, from the rest of the gang. They bringing in an outcome-based approach. Linking, for example, the fee for a system integration project to achieving certain business outcomes for the end client. For example, if it's a supply chain management package that is getting implemented, what impact does it have on the overall inventory costs for the client? So a lot of interesting things that we have observed specifically in the last 12 to 15 months in the APAC region on those lines.
Great. And so we have a question from Taravan, and let me just read that out. We could see that attrition was declining. However, wages have been significantly increased. And we don't have a choice but to raise the rate card in order to minimize operating costs. Customers are looking for lower rate card. So how are we going to address this? Abhishek, Rahul, we want to take that?
Yeah, I'll just add maybe a few comments, and then Rahul, feel free to add in. See, one of the things which you've seen happening, right, and this is not a pointing fingers at any one scenario, but across the board we've seen, the principle is to definitely continue to ask for recalibration where it's needed. In certain accounts, providers may have been able to do it. In certain accounts, it would have been pending because of multiple considerations, and that's perfectly fine, right? Now, the odd thing which sometimes we've seen is that providers asking for 10% hikes, just as an example, rate hikes when they already have a fair market rate in place, right? It's not that they've started with dirt cheap or really hyper competitive pricing, and just because the client is more amenable, right, to hearing, and then there's the push happening. We've also seen cases where providers being scared of asking for 3% where they already have a negative margin deal because the client was aggressive and they would push back. So I think that calibration is really really important to figure out where it's needed and justifiable, because if you look at it, if the client would just turn around and figure out and compare against, let's say, an externalized market benchmark or an objective view as to where they lie versus where they are, it would then tend to fall flat, and then it just leads to a negative impact on the relationship, because then trust issues come in, right? That are you just pushing for the sake of it, or is there something kind of required? So I think it's really important to, even for providers, to use market data to make a fair and fact-based point, right? And then use that to drive conversations rather than use numbers like okay, let's start with 25% and maybe we end up at 10. That's not going to fly, especially in this climate.
Yes.
Yeah, yeah. Yeah, go
Maybe
ahead, Rahul.
just one thing I wanted to add on is, uh, beyond, let's say, looking at the rates. I mean, it's definitely important to look at the rates and ultimately are they profitable, for you as a provider or not. But looking at it from the enterprise's perspective, they're not really worried about rates. They're worried about the TCV or the spend. And there are ways, as Abhishek also alluded to, to get the spend down, even if the unit rates are increasing. For example, there's been more receptiveness from clients, to have greater levels of offshoring, to have more optimized pyramids. And at a minimum, I think what clients do expect is that today the solution which provider brings to the table, it needs to be in line with the market norms. How many people ultimately, as a provider, are you deploying on a particular account? It's fine, and it need not be linked to what it was, let's say, 5 years back. It has to be in line with what the market is currently seeing today. So calibrating your solution metrics, sizing metrics to the best in class practices as of today, that's critically important.
Yeah, yeah. So Abhishek, any guidance to enterprises on how should they think about validating the contracted pricing? There is a lot of change. It's evolving, and any thoughts on that?
Absolutely, yeah. So Ashish, one thing I think which is very interesting to note is
Mm.
that market pricing dynamics change faster today than the pre-COVID era. That's for sure, right? So
Mm.
getting an objective view regularly is essential, right? Because as we've seen, and some enterprises have learned it the hard way, both under and overpaying can be a challenge, right? Overpaying because you're leaving money on the table. Underpaying could lead to the fact that the providers will divert all the good resources to maybe a higher paying client, and that's also, in the larger scheme of things, a strong negative, right? So I think the whole view around, hey, we got something done, or we have some information from 2019 and we'll just use some index to do that, no, that's perhaps not the right way, because that kind of it would often lead to erroneous decisions. So I think that contemporary or context or current nature is important. The second element is also the contextualization. Yes, a lot of internal grapevine information or speaking to friends can get a good rough order of magnitude, But to be able to have a fact-based discussion, right, for both sides, it's important to have exactly contextualized data, right? What's the nomenclature alignment, what's included, what's excluded, right? That's where the devil lies in the detail to move the conversations forward in a defensible manner, right? So I think these two elements are really important. And in my experience, in a huge proportion, if not all, of such exercises, these tend to be self-funding in themselves, because no matter how optimized we think a portfolio is, there's always some element where there is a bit of an overbloat or overcharge, which definitely this can be used to iron out. So that's also something which enterprises need to consider in the long term.
Yeah, yeah, no, I agree. Thanks, Abhishek. I know we're almost towards the end and about to wrap up. So would request the participants to type in any questions, further comments that they have. But before we wrap up, Rahul, we've talked about enterprises and some of the action items that they could take away from here. What about service providers? What do you think could be some of the takeaways or action items for them?
Yeah, I think two very simple but very effective recommendations that I have, and I think we reference them, during the discussion. But let me kind of summarize the 2 points. Ultimately, providers are kind of still thinking of the fee that they're charging to the clients, as a simple P times Q kind of a construct. P being the price that they're charging for the resources that are getting deployed, and Q being the number of resources that they're deploying. So it's firstly imperative to get the billing rates or the pricing correct. And like Abhishek mentioned, it's best to get market data, on this, and not just look at some of the internal norms around this. But in today's times, clients are super focused on getting the right solution, with all the latest automation tools, platforms. You really need to ensure that your queue or the number of resources is also in line with the market standards. And therefore, what we have seen is some of the providers which have been able to increase their market share in recent times. They are the ones that regularly calibrate their solution and sizing metrics against the market best practices.
Yeah, yeah. No, thanks, Rahul. Abhishek, any closing remarks?
Yeah, I think the only thing which I'd mention, this is the year to really keep a very close eye on things which are happening both for enterprises and service providers, because what worked last year is unlikely to work this year. Not just on rates, also around customer behavior, provider behavior. To navigate through this year will take kind of a short term kind of rolling action plan, so to speak. That okay, what are we seeing in March? For example, how's the pipeline going? How's the kind of provider behavior coming? Depending on whether you're a provider or an enterprise. Short term, rather than just kind of thinking, yes, long term plans are important, but they need to be kept on evolving as the year goes. So that would be those would be my 2 cents for this year.
Yeah, no, thanks, Abhishek. Wonderful. So the participants really appreciate you're joining us. I hope you had some good takeaways and good insights from both Abhishek and Rahul. Thank you also for your participation, your inputs, your comments, and we will follow them through if there's something that we haven't been able to address. For those who would love to keep receiving insights from Everest Group, please join in our navigator. You see a link in the comment section. Also, please test our capability by requesting complimentary discussion. So we'll be happy to jump on a call with you to address any of the queries that you may have and see what insights we can offer. So feel free to write to us or just fill in the form, as you can see in the comment section again. Again, appreciate your time and thank you for joining us. Wish you all a very happy rest of the day. Goodbye.
Thank you.
Thank
Bye
you.
bye.
Bye bye.